Good afternoon, Rick. Good to see you. How are you?
I'm doing well. I'm still digesting Thanksgiving dinner, but had a nice restful holiday and ready to kick it back into gear.
Yeah, without a doubt. Thanksgiving is always that pause. And here at RCN, December for us has always been one of the busiest months of the year. We've always chalked it up to investors trying to make their goals, trying to get that money out the door before year end. Some of it could be tax related. I think a lot of it is investors trying to get those assets under control before the calendar flips. So always a great month for us, and good to catch up with you again. So
You
with
know,
that
Jeff,
said, let's get right into it. New home sales, new data. What are we seeing?
well, the most recent numbers came out just today in terms of new home sales, and they dropped a bit. We're looking at annualized sales rates of about 679,000 new homes. That would still be an improvement over last year's numbers, but it's down significantly from where we were a couple of months ago. And I think it really shows the impact these higher interest rates can have across the housing market. So I think we'll probably wind up ending this year with something like 650 to 675,000 new home sales, which is a reasonably good year for that part of the market. And we'd be selling more, except for the builders not building any faster and these interest rates not coming down any faster.
Well, it's interesting. In our conversations over the past 12 months, we've certainly chalked up new home sales to a great deal of the different initiatives, especially that the large scale investors have been putting into place. A lot of that revolving around financing and what lenders have the ability to do when they are owned by that large scale builder, right?
Right.
So, point buy downs, rate buy downs, all sorts of different things. It sounds like we may have hit a bit of a tipping point here over the past month when it comes to rates and what these large builders are able to do.
Yeah, so we've talked about this before too. The median price of a new home sold in 2023 was down about 14% from the peak last year. So builders have adjusted what they're doing to allow buyers to be able to afford to buy a house in today's higher interest rate market. So that's one step, and that's not discounting last year's inventory. That's building less expensive homes to begin with, smaller footprints, probably slightly less expensive materials, and so forth. But they've also been very aggressively buying down rates on mortgage loans. I recently spoke to a group in Denver where I saw a builder advertising mortgage rates of 4.9%. So when you look at the median price of a new home being sold, is only maybe $15,000-$20,000 higher than the median price of an existing home being sold. It's almost a wash in terms of price. You're getting a new home, and the builder is buying down the interest rates from 7.5 to 4.9%. It becomes a pretty enticing offer for somebody who's looking to buy a house. And the other thing, candidly, is there are new homes available to buy where there are very few existing homes available to buy. The inventory levels for new homes today is about 7 months supply, which is right around normal. Whereas if you look at existing home inventory, the number of properties available for sale is somewhere in the 2.5 to 3 month range, which is about half of where we normally like to see existing home inventory. So that combination of lower prices, lower interest rates on a mortgage, and availability have all conspired to really make new home sales a bigger part of the market than they normally are.
Rick, are investors beginning to think about ways to partner with larger builders and bring inventory into the single family rental market? Certainly, as these large builders that have arguably the largest portion of entitled land that's ready to build.
Right.
Are they working with investors today to find single family rental opportunities that they can build from the ground up?
Yeah, that's a great question, Jeff. We've seen two trends among the largest of the institutional investors in the single family rental space. One is that they've stopped buying as aggressively as they had been in years past, and seem to be keeping their powder dry when it comes to buying existing home inventory with the purpose of converting it into rental units. But the other trend is exactly what you talked about. We're seeing them work directly with the builders and do ground up construction of single family rental communities, entire developments of single family homes that in prior cycles might have been designed for owner occupants, but today are being designed for renters. And if I were an institutional investor, the biggest question I'd probably ask myself is why I hadn't been doing this all along. You're not competing with multiple buyers for the same assets. You have complete control over the quality of the materials, of the workmanship, of the finished product. You know what you can put these things together in a way that you know what the maintenance requirements are going to be like, and you have complete cost control within reason. So it just makes a lot of sense to be looking at that approach. That said, it's still a very small percentage of the overall number of single family rental units across the country, probably in the low single digit percentages. But I'd be surprised, candidly, if we didn't see more of this in the future.
Yeah, not a surprise at all. Certainly, we have seen a real uptick in ground up construction requests from investors. And really, it's been coast to coast. The surprising thing for us is, some of the geography plays into it, especially when it comes to single family rental. Obviously, states like California, there's a challenge because of that high just median price that's available, and the rents don't pencil out. But we're seeing a great deal of activity, even in ground up construction requests from the Midwest and the Eastern Seaboard as well.
Yep.
What are your thoughts on how investors are beginning to look at things from a ground up perspective when it comes to geography?
Well, I'll answer your question, but let me just comment on something else you were talking about a second ago. One of the reasons investors are looking at ground up construction, wherever they happen to be looking at it, is because there's nothing else to buy. So if you can't buy a property because the current homeowner isn't selling it, and there's virtually no distressed property available to buy, so that usual market of foreclosure assets that investors tap into isn't available today either, they have to do something. And so it's not just the big institutions doing the ground up construction, but small to mid-sized investors as well. And then your geography comment is spot on. If you're going to be doing ground up construction, or if you're going to be buying a property to rent out, you're going to follow population and job trends. And right now, we have a migration of people moving out of states like California and Illinois and New York, high cost, high tax states, into lower price states. And many of them are taking their jobs with them because they can work from home now. So if you look at areas where you're seeing population growth, it's the Midwest, it's the South, and it's the Southeast. And you're also seeing job growth in those areas. So if you're a real estate investor looking for the best opportunities, you want to be in a market where population is growing and where jobs are growing, because where those two things happen, there's always a need for housing. And in most cases, the need starts with rental housing. And then the third leg of that stool is that in most of those markets, the properties are much more affordable, starting with the cost of the land and then moving into the construction and labor costs. So you're actually getting a probably a more profitable opportunity in markets that are growing. And again, since there's no existing inventory available to buy, you go out and get that lot and build on it.
Yeah, it always used to be we would get all the usual suspects. We would get ground up requests in Texas and Arizona, and to some respect the Carolinas, certainly Georgia, Panhandle, Florida. But now it is really diversified to up the seaboard, even into like the Virginias and that Midwest, super hot. We're seeing a ton, Ohio, Kansas, Missouri, very surprising to us.
Ohio has apparently been a very well-kept secret for a number of years now, but one of the fastest growing markets in the country for the last decade is Columbus, Ohio, despite the fact that Michigan won the football game this weekend. So but you know, it's an educational hub, obviously, with the Ohio State University being there. It's a health center hub, a lot of hospitals and medical research facilities in the area. And now Intel's announced it's opening a chip fabrication plant in the area. So Ohio has been, again, a pretty well-kept secret for the last few years. Tennessee has been red hot. You mentioned the Carolinas. I'm hearing a lot of movement into places like Indiana. And again, a lot of this comes down to affordability and availability of land. You mentioned California earlier as a market where it's tough to do ground up construction for a rental property and make the numbers pencil out because of the costs. Well, it can also take you 10 years to complete construction till you get through all the regulatory hurdles in California. So again, if you're an investor looking to put your money to work right now, California, states like California, to a lesser extent New York, are quite challenging in terms of the hoops you have to go through in order to build. So a lot of these other states are much more friendly to investors and to rental property owners in general. And I think we're seeing people put their money where the opportunities are.
You know, certainly California is well known for high costs, but it's also, you know, the population is in need of housing, even with folks exiting the state to Nevada, Arizona, et cetera. There's a significant amount of migration that just happens naturally in California, just piling on the existing needs of housing in California. And you know, something that we haven't talked about is the accessory dwelling unit and some of the steps that the state has taken to try and make garages, outbuildings available for rent and secondary housing. Maybe you could just spend a minute on that, talking a little bit about what California is attempting to do to address housing shortages through the accessory dwelling unit.
Yeah, tiny houses, Jeff, or granny flats, as they used to call them. The state's actually passed some legislation permitting the splitting up of parcels where there are existing homes to incorporate an ADU of some sort, whether it's a detached garage, whether it's a standalone unit that's either constructed or prefab and put on a slab. Obviously, there's some requirements in terms of things like plumbing and electricity and the like. But it really comes down to zoning. And California is notorious for kind of having the NIMBY type of zoning, not in my backyard. And literally now we're seeing these dwelling units pop up in people's backyards. So it is a bit of a sea change. There's almost no conceivable way where we get enough ADUs in the state to make up for the housing deficit. But it's an interesting and kind of unique start to try and address the housing shortage. And the state government is trying to work with local governments to encourage relaxed requirements in terms of zoning, to encourage more building, more dense building, and certainly multifamily units, particularly around transportation hubs. It's a long process. It took a long time for not just California, but most major metropolitan areas across the country to put in place this sort of single family only zoning that we see in most major metropolitan areas. And it'll take a while to work our way back from that. And it's you know, the thing people have to keep in mind as we go through this is not necessarily going to provide an awful lot of owner-occupied single-family homes. None of these things we're talking about is necessarily going to do that, but we also need multifamily units in these metro areas to accommodate the population needs, and I think that'll probably be the first step.
Makes sense. So we touched on inventory levels a little bit, and certainly as the year has unfolded, we've sort of come to the conclusion that inventory levels are not going to be increasing until we see interest rate changes. Some of your thoughts on where existing home inventory levels are and what you see coming in the near future.
Yeah, if you're looking at existing home inventory, the properties for sale, we're still roughly at about half of where we were back in 2019, which was probably the last normal year we had in the housing market. So if we would normally be looking at 1 million or 1.1 million homes available for sale, we're probably looking at about 550,000 in today's market. What's been a little bit interesting over the last couple of months is that this is usually the time of year when inventory numbers decrease. And instead, what we're seeing is an increase in the level of inventory. It's not massive. If you weren't really looking at it, it almost wouldn't be noticeable. But the fact is the numbers are trending up at a time of year when they're typically trending down. We're seeing a little bit of a lift in new listings, the number of people that are putting their properties on the market for sale for the first time. But the real reason that the inventory numbers are ticking up a bit is it's simply taking longer to sell a house once it's available and listed on the MLS. And even there, Jeff, there's some nuances. If you see a property at the entry level or even mid-tier pricing hit the market, it goes almost instantly with multiple offers. So what we are seeing are more higher priced properties being listed. And since there are fewer potential buyers for those higher priced properties, particularly in today's higher interest rate market, they linger a bit. And we're also seeing a little bit of list price reduction on those properties before they sell. Not massive amounts. You're talking about, 4 or 5% list price decrease. But that, juxtapose that with an entry level property hitting the market and selling for, 10% over asking price. And you can see the difference in behavior in those price tiers.
So that's very interesting, right? So when it comes to the availability of inventory on the marketplace, it sounds like the different tiers of pricing, obviously geography based, $800,000 house in California is very different from an $800,000 house in Texas. But it sounds like when you hit certain thresholds in certain markets, that's where the days on market sort of increase exponentially versus what's, more commonly known as entry level housing.
Yeah, and it would take us several hours to parse these numbers going across the country. But the general rule, I mean, for most investors, what an entry level property costs in the markets where you're doing business. And I think what I've seen almost universally across the country right now is no matter where you are, there's a shortage of entry level inventory for those first time buyers. And those first time buyers very often tend to be millennials who have some other financial challenges as well, not the least of which is now their student loan payments are due again. But that said, entry level properties that are priced appropriately are moving quickly. You're still selling these things in 7 to 14 days. The mid tier of the market is also fairly healthy in most parts of the country. And those properties, again, priced appropriately, we're seeing very little in the way of list price reductions, and they're moving pretty quickly. It's once you get to that third tier, and that varies wherever you might be. For example, in California, mid tier still goes to, $1.25 million or something like that. You don't start to see that slippage until you get maybe over $2 million on a property, whereas you could just about buy West Virginia for $2 million. So you have to keep all these things relative, but the behavior and the way these properties are being marketed and the length of time it takes to sell them is pretty consistent almost no matter where you go.
Interesting. And that's a great segue into, what's driving all of this pent up inventory is the inability of folks to be able to go out and obtain a mortgage for what they may have an existing mortgage on, or even be remotely close. However, since we met last, we have had some changes in the overall 30-year owner occupied interest rate environment. Let's talk about that. We peaked out over 8, and now we're trending down into the 7s. Maybe let's share with folks kind of how that all happened and what we think is going to happen going forward.
Yeah, we peaked with mortgage rates for 30-year fixed rate loan a little bit over 8% for highly qualified borrowers, and as we're speaking today, the rates are down to about 7.29%, give or take. So it's a pretty significant drop off, and not surprisingly, we've seen the number of mortgage purchase loan applications tick up as those rates have ticked down. So it's a very rate sensitive market. I think there's a lot of psychology involved for people that are looking to buy, and suddenly 7.29% doesn't seem all that bad anymore. Whereas if we'd had this conversation a couple months ago, it would have sounded like the end of the world. So we've seen bond yields settle down a little bit, which helps bring mortgage rates down. We've seen the Federal Reserve soften its stance a little bit. It's still rattling its saber, saying it's going to do whatever it takes to get inflation down to 2%. But we've had very good inflation reports the last couple of months, and the expectation at this point is that the Fed will probably stand pat at its December meeting, unless we get an unpleasant surprise in the inflation numbers this month. And I think that will allow the markets to start to settle down, remove some of the pricing volatility that's been in the mortgage rates. And I'm in the school that believes we will see mortgage rates slowly and steadily decline as we get through next year. I would not be surprised by the time we're having this conversation a year from now if we wouldn't see mortgage rates in the low 6s. Now, and that's whether or not the Fed decides to lower the Fed funds rate next year. But the bond markets have calmed down a little bit. So yields on those 10-year U.S. Treasuries have declined. That allows the mortgage numbers to come down a little bit. And we'll see where it all goes. But it does feel like we've probably hit the peak for this cycle and on our way back down.
Well, that certainly is great news. And peaking out over 8%, getting back into what looks to be the low 7s is going to enable, hopefully, an increase in home purchases. Now, I don't think it's going to unlock the inventory that we're so desperately looking for, but at least it's a start. So with that said,
I don't think we see the existing home inventory unlocked. There's two scenarios. One is we get mortgage rates down into the mid to low 5s. And at that point, I think homeowners will be able to rationalize trading in a 4% mortgage for a 5% mortgage, just to use some round numbers, and understanding that it's not the ideal situation they were looking at a couple of years ago, but it's not that bad. In today's market, if you trade in a 4% mortgage for a 7.5% mortgage, even if you buy a property for the same price, you're effectively doubling your monthly payments. And it's not a question of people choosing not to do that. They simply can't afford to do that. Most people simply can't afford to pay twice as much for their mortgage as they are right now. So I don't think the inventory gets unlocked until we get mortgage rates down that low. The other scenario could be something like we saw in California in the 90s, which is you go through a 3 or 4 year period where it's just really a very boring housing market. You and I will be stressing to figure out what to talk about every month, because we will see virtually flat pricing and very, very low sales. And it will just take the market that 3 or 4 year period to sort of normalize. And then 7% interest rates will be okay, because that's what almost everybody will have. But it takes that long period of time of kind of almost a stagnant market before those numbers feel real. But again, if we do get inflation down, if wage growth continues to be strong, if home prices don't spike significantly, affordability starts to get a little bit better. And then if mortgage rates do come down a bit, I think that opens things up, at least on the buying side of the equation.
Without a doubt. So I want to transition to commercial, specifically multifamily, and what's happening in the marketplace. certainly we have seen any number of investors who have experienced the challenges of acquiring more assets in single family rental, as well as buy, renovate, and sell, have started to attempt to pivot to multi, really two different types. Once again, buy, renovate, bring those multi units up to today's standards, and then rent them out at higher rates, or just bring on stabilized debt to acquire multifamily. Once again, more challenges there without the value add because of the high interest rates.
Yeah.
What are we seeing on the commercial side of things, especially with looking at multi?
Well, multifamily and the office sector are the two that are probably getting most of the headlines right now, and for very different reasons. And we'll dive into multifamily, but just a quick note on the office sector. You're looking at major metropolitan areas like Los Angeles and New York and San Francisco with vacancy rates in the high 40% to 50% range. And with, record amount of subletting activity going on right now. It's not promising for those markets. Interestingly, suburban markets and smaller markets aren't having quite the same challenges that those major metropolitan areas are. So even the office market is kind of bifurcated between big cities with big problems and smaller markets that are doing a little bit better. But there are billions and billions of dollars of mortgage-backed securities coming due for those office assets, and there's likely to be a little bit of carnage there. So investors who are looking for opportunities in distressed asset acquisition may want to keep an eye open for offices in their markets. And some of those office buildings are in places where they can be converted into multifamily. I told you we get to multifamily, so that's my segue. On the multifamily side, we also have billions of dollars of securities coming due. I don't expect those to be quite as problematic, although they'll be a little bit messy because of property valuations being a little bit less certain than they were a couple of years ago. We've seen cap rates going up actually in multifamily, but that's because property values have been coming down. So if those loans, if those securities were based on properties being valued at a certain amount of money and the properties are no longer worth that, it's going to be a little hairy when it comes time to reset those loans. It should present some buying options though. And in every one of these types of crises, we do see opportunities for investors. So again, it's a good idea to keep your eyes open. But while you're keeping your eyes open, keep in mind that rental rates for multifamily have been pretty consistently coming down for the last year. Now, part of that's just kind of resetting and getting back to normal. A year or so ago, we were seeing asking prices on new leases at 15% increases year over year. That's off the charts. This is a market where your normal annual increases somewhere between 1% and 5%. So 15% was just completely unprecedented. But now in a lot of markets, we're looking at zero year over year, or even in some cases, minus 1 or 2 percentage points on those new rents. Partly that's again, I think landlords may have overshot on the way up, but partly also it's because there's a record number of new apartment units coming online this year. Some forecasts speculate that as many as 1 million new apartment units are going to come online this year. So you need to be paying attention to what's going on in your market. That total number wouldn't create an oversupply of apartment units nationally, but it may do so in your local market. So you have to be cognizant of what's coming online wherever you happen to be investing, to make sure you're not buying multifamily units at full market value at precisely the time when so much inventory is coming online that your rental rates are going to drop and your numbers won't pencil out. So there's a lot of moving parts in multifamily right now, but the bottom line is that I do believe we have at least another several years of very strong demand in the multifamily market. According to some research from John Burns, something like 28 million prospective home buyers kind of got wiped out by the higher interest rates. They want to live somewhere. That probably means they're going to be renting. So I do think the high price, high interest rate, owner occupied housing market is going to provide some benefits and some opportunities for multifamily and single family investors over the next few years while these things settle themselves out.
So you touched on the actual monthly cost to the end user, right?
Mhm.
We saw rent, right? Certainly during COVID, once we got into COVID and people realized they needed somewhere to live or they wanted to change their living situation,
Mhm.
demand for apartments skyrocketed and so did the rents. But you mentioned that things are normalizing. Maybe you could share with our audience, especially the majority of investors out there, does this mean that we're going to see multifamily rents going back to trend? Are we going to see reductions? There's certainly a lot of hand wringing going on out there, Rick.
I think demographic trends in the long run support continued growth in multifamily rents. There could be some market corrections that happen in select geographies where you actually see rent prices go down temporarily. But I don't think it's endemic. I don't think it's going to happen across the country. And even in those particular markets, I don't think it happens for very long. If you look at markets that really boomed during COVID, you look at markets like Boise, Salt Lake City and St. George in Utah, Phoenix, Las Vegas. We've seen home prices come down. We've also seen rental prices come down on a year-over-year basis because those markets probably got out over their skis in terms of pricing. So they're normalizing. There's some pain involved in the normalizing, but I think once they go through that process, you'll start to see the numbers reverse themselves and they'll start to go back up. Across the country as a whole, and over the next few years, because of household formation, because millennials and Generation Z folks are coming of age, want a place to live that's not mom and dad's basement. I do think those demographic drivers ultimately mean multifamily will go back to kind of its normal levels of regular increases.
So I wanted to switch gears here because I did want to talk about foreclosures. Certainly investors continue waiting for those hopeful signs. When are the foreclosures coming? We've had multiple conversations about this. Things really haven't changed much, but I do want to touch on it, as well as the news that broke last week, which was a VA moratorium on foreclosures. And is that a canary in the coal mine for other segments of the FHA world that may be heading that direction? Maybe we could talk about that as well.
Yeah, great questions. In terms of foreclosure activity, we're still sitting at right around 60 to 65% of 2019 levels of overall foreclosure activity. And that's even as the government's forbearance program almost winds down to its end. There are a couple 100,000 people left in the program. A lot of them are in there because lenders let them take advantage of that program because of natural disasters, not have anything to do with COVID. And as those folks exit, we see some of them going into default, but not the majority of them. Foreclosure start activity is back to about 80 to 85% of pre-pandemic levels. So people are getting that first notice of default. What's very different about this cycle compared to prior cycles, we've talked about this a little bit before, is that about 90% of those folks getting that default notice have positive equity in their homes. So investors who are waiting for these properties to hit the market as distressed assets need to know that in the majority of cases, the borrower gets that default notice, and if they can't work out an arrangement with their mortgage servicer, they're going to sell that property to protect the equity. If you have a $200,000 home and you have $100,000 in equity, you're not going to wait and lose that at the foreclosure auction. So if you're an investor looking to buy these properties, you really need to be working directly with that distressed borrower rather than waiting for the bank to repossess the property at the end of a foreclosure. We talked about the VA foreclosure moratorium that was put into place about a week ago. and will run through May. So servicers have been instructed not to execute foreclosures on borrowers with VA loans through May. I don't think this is a canary in the coal mine. I don't think we're going to see similar moratoria put in place for FHA or Fannie or Freddie loans. This, I believe, was really an opportunity for the VA to rework its loan modification and loss mitigation programs to afford its borrowers the same protections that are already available to borrowers with FHA or Fannie or Freddie backed loans. So I don't think this is a precursor to more widespread moratoria, but I do think it will contribute to a very low amount of foreclosure activity. And that's particularly true as we enter the holidays, when there's sort of an unofficial moratorium that's put in place by Fannie and Freddie and the FHA. So we'll see very little foreclosure activity happening between now and the end of 2023. I would expect to see the numbers pick up a little bit when the servicers start to catch up on the loans they would have otherwise been processing come January and February.
So I guess I'd like to sort of wind things up today with just retouching on the interest rate discussion, the Federal Reserve. There's been a lot of discussion about the Federal Reserve being done with interest rate increases. There's also been a lot of discussion that because of the amount of paper that's been originated to handle the amount of debt that legislative bodies are requesting to fund the government, that's really driving things now. So let's wrap up with that. Is the Fed done? And where do we go, let's say, over the next 90 days on interest rates?
Yeah, you raised a really good point there, Jeff. We've been focusing for the better part of a year now what the Fed's doing, and what might happen next. While the Fed does have a role in it, isn't exclusively about the Fed anymore. But let's talk about the Fed first. Consensus really is that the Fed is done raising the Fed funds rate for this cycle. Consensus certainly is that they should be done because they've raised them fast enough and high enough, and really just need to give those rate increases the time required to have their effect. We've had a couple of really good reports recently on inflation numbers. We've also seen the job market soften a little bit. We've seen wage growth soften a little bit. Those are all things that the Fed doesn't say too much out loud about, but are part of its inflation fighting strategy. And I think things are moving in the direction that will allow the Fed to take its foot off the gas at this point. Or I guess the foot off the brake would probably be the better analogy. I'd be surprised if they raise the Fed funds rate in December. I do not expect to see the Fed cut the Fed funds rate anytime soon. Earliest scenario is probably the middle of 2024. We might start to see them to scale back a little bit, unless we have a recession that's a little deeper and more severe than most people are predicting it will be, and they feel the need to stimulate the economy. But the other thing that the people aren't talking about too much is the impact that the bonds market could have on interest rates. And you raised a really good point, Jeff, about the government needing to be funded and the deficit spending. I think we're looking at about a $2 trillion deficit in the last fiscal year, which is just insane. We're also footing the bill for wars going on in the Middle East and Ukraine right now, in addition to whatever it is we're doing domestically. And with interest rates being as high as they are, just the interest rate on the debt payment is going to be a significant part of the U.S. GDP. The bond market doesn't like those kind of scenarios, and because of that, we often see bonds yields increase. If that is the case, that has a direct impact on mortgage rates. So if it were just the Fed we'd be looking at right now, I think we'd see mortgage rates continue the decline we've been seeing over the last couple of weeks in a slow and steady manner over the next 12 to 18 months. The wild card here really is what happens in the bond markets and what happens with bond yields if we need to fund the government using those treasuries. So it'll be, to say the least, an interesting year. And of course, 2024 is also a national election year, at which point really all bets are off when it comes to, fiscal or legislative sanity. So I still think the most likely scenario is we see mortgage rates dip from the 7s into the 6s next year. But there are just exigent factors that we're going to have to keep our eyes on, and don't be surprised if we see things bump up and back down a little bit with some volatility next year.
Well said, Rick. Always good to catch up with you. Thanks so much.
Take care, Jeff. Thank you.